right. Good afternoon, everybody. Thank you for joining us for our February Basics of Investment session. With me today, I have Mark Hoge, who is kind of our expert in that area and is going to talk with everybody about investing. Mark, go ahead and take it away.
Good day, everybody. Welcome to our webinar today. I appreciate the opportunity for everyone being here. Thank you for taking the time out of your day. This should be fairly quick. Like Nicola said, we're going to cover some basics of investing today and just making sure that we have everything taken care of. Again, appreciate you attending the presentation. My name is Mark Hogue. I am a financial professional from LPL Financial. Today, we're going to be talking about the basics of investing. Many people find it to be challenging to get interested and engage with investing and the planning and strategies that come with it. So that's understandable, and we have a lot to learn and understand when it comes to that. So we're going to kind of go over some basics today when we handle this slideshow. We'll have some questions go throughout the day as well. We'll have breaks. You can ask questions if you would like to, and Nicole will help with that. Um, the attached, what we have is called an approved as is status by advertising review. So for advisors, we wanted to use and or customize pre-approval materials. They must first review the communications with the public chapter of the Advisor Compliance Manual, specifically the sections of commonly used disclosures and pre-approved communications. There will, there they will find instructions on how to use the correct book, broker-dealer disclosure using pre-approved materials and how to meet their books and records of requirements. So just have to read this right away. This is part of our compliance to make sure we are doing our due diligence for you guys. When we take care of this. So, going into the next, we have are you ready to invest? Is your first question. Second step is to be talking to talk. There's four steps to becoming an investor, and then what kind of investor are you? So these are the four different areas that we are going to cover today in this PowerPoint. So we are going to start out with number one being, are you ready to invest? So this is where we're starting out for one. You know, everyone always asks, when am I ready to invest? What am I looking to do? How do I start? Where do I look? And so that's where we're going to get to today here. So with that being said, what is your investing approach, right? I prefer to figure it out by myself. I just need a little guidance and I'm good. Or please, can someone just take care of this for me, right? There tend to be three different categories that someone falls under. And these tend to be one of the three. So the first approach is recognizing um, what area you are actually in yourself when it comes to the investing approach. So to help kind of focus on, are we ready for the income? Um, Investing may seem intimidating process, but the sooner you start, the better. The easier it will be to begin building a nest egg for your future. Since investing always includes some risk, right? Even a basic CD, technically there is very minimal risk, but there is some involved, right, on all scales. It's important to have a solid financial foundation before you begin. Here are some key things to make sure you have covered to make sure you're ready to invest. Number one is you have a steady income. I always want to make sure you're covered and taken care of with money coming in on a frequent basis. You have money left over after meeting your financial obligations. It's very important to not make yourself live broke. You do want to make sure your necessities are covered on a daily basis first. You've considered the effect of upcoming personal challenges such as marriage, children, or divorce before investing. Again, that goes back to just wanting to have money prepared for something coming up if need be. And then you've built up your savings, including a 3 to 6 month emergency fund before establishing an investment account, right? We have things that we have that come unpredicted. Having a steady income may seem obvious, but it's important. If you are only working part-time or your income is from freelance or contracting, it may be more challenging to develop a formal ongoing investment plan, but it's not impossible, right? So you want to make sure you have funds available for just in case something comes up because life throws unexpected things at you and you never are quite sure or able to fully plan on when something might come up on the life side of things unexpectedly, which would cause financial impact. So, number two, first, let's talk about right basics, right? So, talking to talk. Okay. Knowledge is investing power. Okay. So, you got the Wall Street Journal. Being ready to invest also means making a commitment to increase your knowledge by subscribing to daily financial news reports such as the Wall Street Journal, as mentioned, among others available. So Wall Street's not the only thing. We LPL, we do have a LPL financial service where you can sign up to have research from LPL submitted to you weekly. So it's very similar to Wall Street Journal. It's another reliable source. It's LPL's version of the Wall Street Journal, if you will, as a comparison, having access to stuff going on in the market. So if that's something that interests you, that's something that also can be a report that can be signed up for as well to stay up to date with what's going on in the investing world. Now, to jumpstart your investing knowledge, here are a couple major investing benchmarks you may be familiar with but need to know more about. First up is the Dow, the Dow Jones Industries Industrial Average, which is the oldest and best known of the American stock market indexes. The index began in 1896 and currently consists of 30 blue chip stocks. The stocks are selected by the editors of the Wall Street Journal, which not so coincidentally is owned by the parent company Dow Jones and Company. So you kind of get the connection of the company of the name. The companies represented in the index are actually quite diverse, representing all the major business sectors. You would recognize most, if not all, of the companies represented, including Johnson and Johnson, Coca-Cola, McDonald's, different companies of that and type of entities. The criteria for a company to get on the Dow is that the companies are leaders in their industry and are very large. It takes a significant change in a company for it to be removed from the index. Thus, the Dow Jones is considered an important and consistent benchmark in evaluating how the stock market is generally performing. Um, at this time, I just want to double check and Nicole, see if we have any questions based off of the first few chapters that are slides that we've covered.
I don't have anything right now, Mark, that pertains to the first portion. So feel free to add any questions in the chat and we can certainly get those to Mark.
Apologies on sliding. I didn't know my mouse slid it so easily. Okay. On to the next. Um, this is one perhaps less familiar is another marketplace. This is known as the NASDAQ, is how it's pronounced. Um, it's market known as the NASDAQ Exchange. It stands for National Association of Securities Dealers Automated Quotations System. I want to make sure to say that slow enough so you could have each word for those if anyone's taking notes. But you can see why it is called the NASDAQ in short. Um, Although in conversation, people just go by phonetic pronunciation, NASDAQ, as we had stated. In the last quarter century, NASDAQ has emerged as one of the largest and most popular stock exchanges and was the first exchange to offer online trading. Stocks that are traded on the NASDAQ exchange tend to be tech companies like Apple, Facebook, Microsoft, and Google, to give you some ideas and pictures of that side. However, companies on the NASDAQ don't have to be as huge as those icons themselves. There are smaller companies like Angie's List. That's the website that offers peer-to-peer reviews of home repair contractors. And the 1-800 Flowers are also listed on the NASDAQ exchange. So the NASDAQ's not completely high level only. It's actually something that is spread out through multiple different levels. Um, while the NASDAQ generally tends to include many tech companies, it also trades some banking companies, airline companies like Spirit Airlines, and even a few non-tech businesses like Starbucks, a shoe company, Stephen Madden. Amazon is also traded on the NASDAQ. So it's pretty diverse on level, just depending on how you are investing. Um, Third part we get to here is 4 steps to becoming an investor. Um, Now that we've covered some ways to set yourself up for the investing success, right? Covering the different, mentioning the different areas of where you would want to look to invest or look to compare and contrast. Um, let's look at what I like to call the 4 steps to becoming an investor. So at this point, step one is you learn which investments are appropriate for your financial goals, right? This is where you talk about whether it's saving for retirement, buying a new home, funding a college education, or any other financial goal. We'll look at some key types of investments available to help you, and knowing what you're investing into helps determine, what type of investment best suits the goal that you are trying to reach. Um, So, stocks or stock mutual funds, a stock also known as shares. So, if you hear someone say shares or a stock, they do mean or equity. It all means the same thing. It is a type of security that signifies proportionate ownership in the issuing corporation. This entitles the stockholder to that proportion of the corporation's assets and earnings. Stocks are bought and sold predominantly on stock exchanges and are the foundation of nearly every portfolio. Um, they are what really drive the force of growing your portfolio to at a level that is able to help you prepare and really reach the retirement goals that you're looking for long term. Stocks and stock mutual funds have a risk with have a high return potential, but the potential risk with the stocks is also high. So the higher return that you're looking for, the higher potential of risk. So it's really finding that level that suits you on a risk tolerance basis. For the average investor, they are typically considered as part of a long-term investment goal, such as a 401k or an individual retirement account, which is also known as an IRA in short. Um, that is where you have much more time on your side and can afford to be more aggressive and take on more risk, because the long term ends up being much more beneficial than the short term when it comes to those riskier investments. They may not make sense for a short term, right? Goal where safety is more stable. So that's where you'll tend to look at something more on a maybe less risky side when it comes to your investments. Um, the next part we have is bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds are debt holders or creditors of the issuer, right? So this is where, just like you have a loan and it's paid back on an interest. Bond details include the end date when the principal of the loan is due to be paid to the bond owner and usually includes the terms for interest payments made by the borrower, which would be um, the company that you hold the bonds from. Historically, bonds and bond mutual funds, they are similar, are known for their potential to generate consistent, moderate returns, which which actually may work best in a medium-term investment goal, such as like a college fund, where you can take on some risk, but not a lot. So you get a good rate of return without trying to lose too much potentially for the college fund. In addition, as you get closer to retirement, within 10 years in general, there's no exact date. Bonds and bond funds may also become a bigger part of your retirement account portfolio. If you're looking to get less heavy on the stocks, but still want to have some growth potential while taking on less risk at the same time. And then we have another one is cash equivalent investments are typically money market funds. They're known for consistent lower returns, but with much lower risk than bonds and stocks, which may make more sense for a short-term investment goal, such as saving for a down payment on a house or something like that, potentially. As you get closer to retirement within 5 to 10 years in general, cash equivalents may also become a bigger part of your retirement account portfolio. If you're seeking to minimize risk at that life stage. And again, that depends on what return you're looking for at that time based off of what the market is performing and functioning based off the different levels. This here is some perspective on the major asset classes and how they have performed over the long term. History reminds us that the greater the risk, the greater the potential reward, right? As we had talked about. Let's take a quick look at historical returns of key asset classes from 1985 to 1922. And this is where you can see, right, over this time frame, your stocks have returned you, 8% per year as your average return per year, right? So that means from 1985 through 2022, with all the ups and the downs and all those negative years that happened, the stocks that you've actually returned a rate of return percent of 8% per year every single year since 1985 as your average. And then when you look and scroll down, you can see the bonds, right? They've actually done a 3% rate of return as your average return per year for that same time frame. Your treasury bills, you can see 0.4%. And then this is the key here is inflation, right? So inflation is 2.74%. So you want to try to earn above 2.74% on your money. By doing that, that means your money is at least growing higher than what inflation is impacting the dollar amount. So you can see in the long run, even if you go conservative with bonds, you can see you're still at least beating inflation, the average inflation rate over the same time frame. Now let's look at step two to becoming an investor. Embrace diversification. This is one of the most fundamental aspects of investing. Putting your money into a number of different types of investment options that include different types of asset classes can help manage risk. Generally speaking, if your dollars are invested in materially different types of investments, and market conditions cause one of your investments to not do well, all of your money shouldn't be affected as negatively, as if you have your eggs in one basket. There is perhaps no better way to illustrate this than to look at the story of Lifesavers candy. So the Lifesavers candies spread the risk to help manage your potential rewards, right? So to have this comparison, Clarence Crane invented Lifesavers in 1912. He manufactured only one flavor of the Lifesavers, peppermint. Okay. In 1913, Crane was approached by Edward J. Noble. Noble suggested that offering different flavors of Lifesavers would attract more customers. Crane wasn't interested in the concept, but agreed to sell the Lifesavers business to Noble for $2,900, so $2,900, right? In his lifetime, Noble went on to develop a $1 billion business manufacturing different flavored lifesavers by diversifying his product. He appealed to more people and protected his business from the risk of one flavor losing popularity. Diversification can help with investments too. Spread the risk to help protect your potential rewards. So, step three to becoming an investor, I'll give you a little economic 101 lesson here. It's really important to understand how the economy can affect your portfolio. The state of the economy, which is how a country uses money and resources to produce goods and services, it greatly affects stock market activity. Whether the economy is growing, shrinking, or standing still, it influences stock performance. To understand the impact of the economy on your portfolio, we'll take a look at how a few different economic factors affect the stock prices. So we're going to look at bull versus bears. There's two different markets. With a bull market, an investor's confidence is high and stock prices are on a rise, as most stock holdings will increase in value. So that's when you see the whole market really increasing and on a straight incline side. With a bear market is when investors are nervous, stock prices are decreasing, and many stocks are considered undervalued. Um, this can also be an opportunity to stake in good companies as a discount in their stock price uh, when you are inside of a bear market at the time. When there's inflation, prices are rising and purchasing power is falling, which we recently saw here going with the rates increasing since COVID. Um, a dollar buys less than what it used to. But when inflation spikes too high, people can't afford to buy as much as they could before, and corporations may start to lose sales causing stock prices to drop. This can create a drop in investment values. Uh, when there is low inflation, this can indicate a healthy economy, which can be good for the stock market and stock prices. So, looking to, right, purchasing power, not just the stock market value, but how the company performs on a daily basis in their general business also impacts how the value of the company is working. So low inflation equals potentially good returns for your portfolio. High inflation equals potentially bad, right? And potentially because that does not always end up being the case every time. Here, interest rates include credit card interest rates, mortgage rates, car loan rates, and even the savings rates you receive on a savings account at your bank. Um, when interest rates increase, stock prices tend to decrease. And then when interest rates drop, stock prices usually rise. So that's where we've seen as the Fed has been dropping these last few years, the stock prices has been rising. So in 2000, right, 2019, the Federal Reserve, aka the Fed, is what they're referred to in short, the government entity with the responsibility of implementing interest rate strategies to support the economy. That decreased rate interest rates on three separate occasions. They did this in an attempt to help offset a potential recession and avoid an economic downturn. Um, do please note that the inverse relationship with rate setting by the Fed and stock prices, right? So again, when like we talked about here, when rates go up, stock prices generally go down. And then when rates go down, stock prices generally go up, right? So when we're looking at how the Federal Reserve influences the stock market, again, it is not an absolute direct correlation, but you do see a resemblance and a tie in comparison when that occurs. So then we get to step four, and that's where you look at seeking professional help. While the presentation gives you some basics, it does help you get started with investing. You should know that the professional help is available if you need it. It's important enough to be our fourth step in the becoming an investor. LPL financial professionals can give you hands-on professional and personal guidance and advice to help you determine your financial goals and how you can potentially achieve them through investing. Um, Here is how we can help. Um, One thing that on our side, when we go with the financial professionals, we're able to help you understand different types of investments and their places in a balanced investment portfolio, right? Making sure things are spread out. Don't put all your eggs in one basket. So you're protecting yourself. We also help you determine your financial goals, such as retirement, buying a home, funding a college education, starting your own business, or just getting better at budgeting and paying down credit card debt as well. We will help you determine an appropriate investment strategy to pursue your financial goals based on your risk tolerance and time frame. Discuss professional management, investment strategies that may be of interest to you, and then meet you on a regular basis to track progress and adjust as necessary for your goals, right? Year over year, you might change a goal, funds might change, income might change, making sure we're staying on top of that to stay in alignment with your goals long term. The next part we have is what kind of investor are you? So what we have here is this is a little questionnaire. It was not able to be printed out. So what I am going to do is just read these questions to you here myself and have you answer um, uh, one, two, or A, B, or C, which is 1, 2, or 3 points. So first question, if you want to just kind of go along, this is kind of for your own notes here. Um, how many years do you have until retirement? Is it less than five? Is it 5 to 10 years? Or is it more than 10 years, right? So less than 5 years is 1 point. 5 to 10 years is 2 points. More than 10 years is 3 points. Um, Second question is when it comes to making investment decisions, which of the following best describes you? If you feel you're not very knowledgeable, that would be 1 point. If you feel you are somewhat knowledgeable, that would be 2 points. And if you feel you're very, very knowledgeable, that'll be 3 points. That again, that's for question number two. There's five questions total. The third, excuse me, question is, are you willing to take on more risk in exchange for potentially higher rates of return? Right. So again, are you willing to take on more risk in exchange for higher rates of return? No is 1 point, not sure is 2 points, and then yes is 3 points. Question four is when making investment decisions, which of the following best describes your philosophy? I worry about losing my money and lean towards having more conservative investment mix. That's 1 point. 2 points is I believe in taking my time and in investigating all my options before making a decision. And then that's 2 points. And then 3 points is I would not hesitate to take on higher risk because I know it's the only way to achieve potentially higher returns. So that's question four. And then the final question we have is which of the following best describes your current attitude toward investing for retirement? So 1 point would be I tend to worry that the value of my retirement savings will go down. 2 points is I would like the opportunity for my retirement savings to grow, but am only comfortable with a medium amount of risk. 3 points is I would like to the opportunity for my retirement savings to grow as much as possible and am willing to take on high risk for potentially high returns. Sorry, not rewards, returns. So that is question number five. So at this point, um, when you add up your score, there's five different levels. So there's five different risk categories. There's conservative, there's moderate growth, there's growth, and then there is aggressive growth. So if you're between 5 and 7, you're an investor who generally likes to seek stability and safety for your money. Not having enough money when you retire is a big risk too. Keep in mind your time horizon and the impact inflation can have on your investments, right? So that goes back to if the average inflation since 1985 has been 2.75%, you want to look to at least earn above that so your money continues to grow at a higher rate than inflation itself. If you had a score of 8 to 9, you want your money to grow, but are more concerned about protecting it. You are cautious, but may be willing to diversify to spread out some of your risk, depending on your time horizon. If you're a score of 10 or 11, that you would be considered what is moderate growth. You like the balance. Uh, you like to balance lower risk investments with higher risk investments, right? You evaluate your situation at least annually to make sure that this balance contains the risk mix of low risk and high risk investments for your situation that best suits you on your comfortable risk tolerance that you have. If you are a 12 to 13, that's a growth. That's the fourth category. You want to increase your savings and are somewhat comfortable riding the ups and downs of the stock market in exchange for the possibility of higher returns over the long term. And then the last one is aggressive growth. That's if you had a 14 or 15, you answered a three basically to every single question. Um, you want to maximize the long-term growth of your retirement savings. You are comfortable taking substantial investment risk in exchange for potential high returns. You evaluate your situation at least annually and modify your investment strategy as the situation changes. So I want to close out the presentation by pointing out that a big part of becoming an investor is determining your tolerance for investment risk. Everyone is different. It's important to be honest with yourself about your appropriate and appetite for risk. Um, at the end of your the sorry, I realize that is a note. So we already did the quiz. We just took care of this quiz. So on to the next page. This kind of gives you a breakdown of the five different categories. So we got conservative, right? Here's your 5 to 7 points. Here's kind of a breakdown of what your percentage of investments would look like. Percentage of cash, percentage of bonds, percentage of stocks. And then if you go from conservative and we flip all the way over to aggressive, you can see it's basically completely changed. You got 65 to 90% stocks on the aggressive side, a little bit of bonds and small cash. And then right in the middle, which tends to be most people, you tend to have almost half your money in stocks, close to half your money in bonds, and then the remaining balance in cash, depending on what you are comfortable with when it comes to your risk tolerance. Um, so that is that is towards the end. So this again, this presentation was created for educational, informational purposes only, and is not intended as ERISA, tax, legal, or investment advice. If you're seeking investment advice specific to your needs, such as advice services, must be obtained on your own, separate from this educational presentation. This material is for general information only and is not intended to provide specific advice or recommendations for an individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risk, including the loss of principal. So, with that being said, again, I want to say thank you to everyone for the time and then want to open it up a little bit here for any questions that anyone might have at this time before we let everyone go.
Mark, as we're waiting for questions to come in, just wanted to kind of ask you about if somebody is just not sure, and I know this question comes up a lot as I do community events. Um, what is the charge to just come in and talk with you or another one of our financial advisors?
There is no charge just to have a conversation. So if you just want to come in and have a breakdown or bounce your ideas or just bounce financial questions or situations off of someone and just need an ear to listen, it does not cost anything. Our services do not actually, the charge for our services does not actually take effect until you officially start doing business with us in managing or handling your accounts. So just to talk to us doesn't cost anything.
Perfect. And again, any questions, feel free to add them to the chat function. All right, one question just came in, Mark. Great presentation. If you have a company 401k, do you have clients move some money from that to other investments with someone like you?
Generally, yes, that will happen, right? The 401k is owned on the company side, right? What tends to happen is the general process is once you reach retirement or you no longer are working with a company that has the 401k, or you just want to have some different investment options to change a different investment opportunity to get some type of return. You are able to roll your money out of the 401k and would open up what's called the, as we had listed in the presentation, a individual retirement account. That individual, which is called the IRA, that would be individually owned by you. But then at that point, I would be someone like me or me would be able to help manage those funds for you, and then break down, and we'd go over, a in-depth breakdown of what type of investment you wanted, which one of those five categories you would fall under, whether it's conservative, moderate, or growth, and put a portfolio of stocks and bonds together that would fit and suit your specific tolerance. So we are able to move that money over and put it into an IRA and manage that for you if that's something that piques your interest.
All right. Another question that comes up often, Mark, is how much is a minimum that I have to have in order to invest? Like you hear lots of times people need $10,000 or $5,000. Is there a minimum that typically you ask for people to have?
Um, it depends. There are different thresholds, right? Being that is in an investment world, there are different platforms that if you have higher thresholds, you're able to get into different platforms that are more extensive and in depth when it comes to the investing. But to start out investing wise, you can get in with a couple $100, two, $300, $500. Um, at least be able to get you access to get into at least some type of funds in the market and be able to grow versus having to actually have 10,000 or 50,000 or something like that. Um, Obviously, if you have 10,000 to start or 50,000 to start, it does help. You get you technically have more access to some additional investments because the platforms you have access to more platforms. But at the end of the day, it is you do not need that specifically to be able to start investing. So, like I have, for example, I have what's called uh, minor accounts, right, for little kids, where parents open up and they'll start with like $250 open an account and they'll put money into it, a few times a year. And then by the time the kid reaches the age of 21, they'll have like, $5,000, $6,000 in the account or $10,000 in the account that they get to use for whether it's college or, um, you know, something living wise as well. So you're not restricted to have a high dollar amount in order to start an investment.
Perfect. Thank you, Mark. I don't see any other questions that have come through. So if we wanted to, we could probably give them an extra 14 minutes back on their afternoon or on their lunch hours.
Perfect. Well, that sounds like a plan. Again, I appreciate everyone for your time and joining the webinar. I hope it was helpful and beneficial to everybody, and I hope everyone has a great day.
Thank you, everybody.